Hey, welcome. This is Steve Wolf, the managing partner for WWM Financial, with another of Steve's stock stories. And today I'm going to talk about a person who I got to know who really did not make a whole lot of money, but ended up with seven figures in his retirement account. This was a fellow who was actually a doorman and a maintenance man at a condominium down in Florida, in Miami Beach. My folks had a place down there, and I would go down there and visit them every once in a while. And I'd see this guy whose name is Lou. Lou had an Italian last name, and to be honest with you, I can't remember his last name, but Italian guy. You look at him and you say, geez, who is this guy? He's wearing his uniform, but the shirt is kind of open up at the top. You got hair coming out of it. He's kind of unshaven, and at the time that wasn't cool. And, his hair was kind of messed up and a little bit overweight. And I'm thinking, okay, so I'm talking to this guy, and this is probably back in the early 80s when this happened. And he was saying to me that he's buying Home Depot stock. And he was telling me why buy Home Depot, blah, blah, blah. And, and he said to me that what he was trying to do is put as much money as he possibly could in Home Depot, because that was going to be his retirement plan. Now, I kind of questioned that. And at the time, I wasn't in this business. It was prior to me being a financial consultant. But I'm thinking, why would you put all your money in Home Depot stock? Well, what ended up happening is several years later, and probably 10 or 15 years later, I'm talking to him as I'm visiting him one day, and he says he's going to be retiring. And, there's a guy who, would get people's cars, and would get $1 every time he got the car. And it couldn't have been making a whole lot of money as a maintenance man at this condominium. But I said to him, do you have enough money to retire? He says, yeah. He said, do you remember all those times I told you to buy Home Depot? He says, I told everybody to put money into Home Depot. I said, yeah, I remember that. He said, well, I did that. He says, every spare dollar I had went into Home Depot. And he said, the stock has just done unbelievable. And he says, I am now in the seven figures, over $1 million from what I first started with. And I kind of looked at him and I said, are you kidding me? He said, no. He said, Home Depot has done great. So I was thinking about that. This is a lot like my own story with Bed Bath & Beyond, which, by the way, that was on our first Steve Stock Stories, which if you didn't hear, you could get at wwmfinancial.com on our website. It's got that and a lot of other things. But it reminded me a little bit of that, because I put a lot of money into this one stock that just came public, and it ended up doing really, really well. Now, would I say that a strategy of buying one stock is a good strategy? The answer is no, but it certainly was great for this particular person, for Lou. Lou did really well with saying, hey, I'm going to put all my money in Home Depot. And I mean, truthfully, I don't think Lou's probably even alive today. This has been a long time ago now. It's probably 40 years ago, and I'm guessing he was around 60, 65 back then. But had he continued to, if that money continued with his heirs, I mean, it's just worth really a fortune. So, again, it goes back to a theme of, people say, I can't beat the stock market. I have to be in an index. I have to be in something that has a gazillion stocks in it. Now, again, putting your money in one stock is too risky, really, for just about anybody. I would say for 100% of the people. Although if you look at if you look at people who worked for Microsoft, or probably or any of the companies that have really done really well, and they had stock options and stock, and they continued to buy stocks here and there. As time went on, they made a lot of money. I know the people who worked for Microsoft, you heard about secretaries, retiring with millions of dollars. So certainly it's more than possible to do it. I certainly wouldn't recommend doing it with one company. Now, the really good thing about this story, in my opinion, beside the fact that he was able to retire in somewhat comfort, and remember, 30 years ago, $1 million is it's probably worth more today than it was back then. But one of the nice things about this is it talks about, dollar cost averaging. I think people forget that, what they're really doing is investing. It's not just a dollar amount. It's not just a number. It's actually investing in a company that's making more and more and more money, hopefully. I mean, that's what you're looking for. So no matter what happens, if you are continuing to put money into a company that does really, really well over time, you'll do really well over time. And that means, you can't get scared when things like the COVID virus hit and we're down by a lot. I mean, to me, that's an opportunity, if you still know the company, still believe in the company, to put more money in there. And whether you're doing that with an individual stock or you're doing that with a mutual fund, with an index, it's still the same. A dollar cost averaging works. And basically what dollar cost averaging is you put a certain amount of money in to whatever that security is or the mutual fund or whatever periodically. So maybe you do it once a month, maybe once a week, maybe once every 2 weeks, whenever you get paid. But you do it religiously, okay? And it means you're going to get an average cost over time. And that's what this guy did. I mean, a few dollars here, a few dollars there, and my goodness, I mean, he ended up with over $1 million. And this was a guy, I'm telling you, he just wasn't a wealthy guy. And to be honest with you, I mean, if you talked to him, you wouldn't have thought he was the brightest guy in the world either. Okay, so you don't have to be a brilliant mind. You don't have to have an income of $500,000 a year to do well in the stock market. You just have to be able to pick a few really good stocks or good funds or good whatever over the course of time and continue with your conviction. So that was the other thing that, in my opinion, was really important. He believed with all of his heart and with all of his research that Home Depot was going to gain market share. It was going to knock the mom and pop businesses really out of business. It's kind of what they did. Home Depot, and then Lowe's came in, and there's some others. But I mean, those companies have just taken over. And if you're looking at right now, especially with the COVID thing, the big companies absolutely will survive this. We're not 100% sure whether the moms and pops of those businesses are going to make it, but the big ones will. So Lou, here's to you. I think you did a good job. And as usual, I've got Jocelyn Magana here with me. He will tell you that he's not an advisor, but he has a good brain. So Jocelyn, how's it going?
Hey, pretty good. Pretty good. When I came in this morning and I said, hey, what are we going to talk about? And you're, hey, we're going to talk about the doorman. I thought, what are we talking about? First thing you tell me is how we bought Home Depot, one stock and killed it. I love hearing that, but there's another side. I mean, everybody's got to remember, I'm the regular guy here. I learn a lot more because I want to keep up with the advisors to some degree so I can know what they're talking about. I ask them a lot of questions. I, get audio books so I can at least have, some form of knowledge on this type of thing. But I certainly don't have the experience and the training and knowledge that Steve and the other advisors here do. But the first thing I'm thinking when he tells me that is, that seems crazy. That seems crazy to bet on one stock. And, part of me wanted to jump out of my skin and say, hey, isn't that the wrong thing to do? Before we got into a deeper conversation of there's the home runs. And then, as I had mentioned this morning, I read, usually all the headlines in the Wall Street Journal in the morning, so I can kind of know what's up when I come in here. And I'd never heard of this product before, but the first thing that came to mind was these structured ETNs. Do I have that right, Steve?
Yeah, they're exchange traded notes, but those are a little different. Exchange traded notes, they're put together by a bank, but they're usually highly leveraged. And one of the things that we have talked about a lot, not necessarily on my podcasts, but with clients and with prospective clients, is that you don't want to be highly leveraged. That usually is a recipe for disaster. Back in the 2008, 2009 debacle, I mean, that's what happened to Lehman Brothers. They were levered, I think it was something like 30 or 40 times. And of course, when things went against them, they go out of business. So the exchange traded notes, what they're doing is they're doing 1 or 2 or 3 times what you can make on the upside. But of course, that also means you can lose 1 or 2 or 3 times on the downside. And a couple of these have, more than a couple, I guess, have imploded. And what happens is at the end, these people who put their money in there, they're going to end up, if anything, with just a couple pennies on the dollar. So that's not the same thing as buying an individual stock. But it's certainly an individual stock has a lot of risk.
I guess you're right. From that perspective, it's apples and oranges. I guess where the two connected the dots for me, my brain just jumped from one to the other, was that in the article, a gentleman, was doing well with these for a while, and they had a good run. I mean, a really good run. So much so that he took all of his money, put it in this vehicle, and he's pretty much decimated.
Right.
So that's kind of what comes to mind for me, and that's kind of what I wanted to bring up. And I think you'd already addressed it in saying that, hey, is this the strategy? Yeah. Absolutely not. But I also get that people can do really well.
Yeah. I mean, look, we would not recommend putting all of your money into one company. As a matter of fact, when we get people here who come from a company that they had a lot of company stock and it represents, 50, 60, 70, 80% of their portfolio, we want them to diversify because anything can happen to one company, certainly good or bad. And that was why I was skeptical about Lou with Home Depot. I said, why would you do that? I mean, what happens if the stock goes bad? And of course, he had the conviction and he turned out to be right. I guess if he turned out to be wrong, he would have been decimated. You're absolutely right.
Well, it's nice to hear the wins though, too.
Oh yeah. So. But if you can put a portfolio together, I've said this before, you don't need hundreds and hundreds of stocks. But if you can put a portfolio together of 5, 10, 15, 20 stocks, that to me is really all you need. I mean, my portfolios that I have, one of them only has at the current time 9 stocks in the portfolio. The other 2 each have between 25 and 30 stocks. But I think that's enough, and besides which, I think especially if you're trying to do it yourself, how many stocks can you really follow closely? You can't follow 400 to 500 stocks. You just can't, and you're going to get some good with the bad. And yes, there is less risk, I suppose, on the downside as far as volatility, the more you have. But the more you have, the more mediocre I think is going to be the return. So when you do an index, you'll do okay because the indexes do okay. But I've said this before, why do you want the bad stocks in with the good stocks? Why not pick the good ones? Now, everyone out there is saying, well, yeah, but you don't always pick the good ones. And that's true. Matter of fact, I pick a lot of bad ones. The idea though is that if you can pick out of 10 stocks, if you can pick 6 or 7 that are good and control the downside of the bad, you're going to make a lot of money. And if you really have conviction, if you really think a company is going to do great, that was me with my Bed Bath & Beyond story. Quite honestly, it's me with NVIDIA. And again, these are not stock tips right now because I don't know your situations. But for me, I bought some NVIDIA and the stock went from like 140 where I bought it to about 280. And I actually sold a little up there and then it went back to 140 and then I bought more. So now it's back to it's up to about $350 as we speak. Again, not a stock tip. Don't go out and go buy it right now because who knows. But I had a lot of conviction that was going to be a great company. Why? Because their chips are in the gaming industry. They're in the auto industry, the cars that are going to self-drive. And they're right in the middle of it. They're in that sweet spot. So, you get a few stocks like that and you don't need a whole lot more. Currently, a lot of the stay-at-home stocks are doing well. I mean, look at a DocuSign. Again, I'm not recommending it necessarily because it's actually run up quite a bit. If anything, I'd probably be on the other side of that. But DocuSign's up in the last 2 years, almost 300%. And why? It's because we're going more to working at home and not being in an office and not seeing people and everything is becoming electronic. So, you don't need a lot of stocks to do well. You just need some pretty good ones and then watch the downside.
Yeah, I guess the old saying is, right? I mean, from the perspective of somebody that is not a professional, I think you said something to me before when we were talking about this subject and you may have brought it up in the last podcast is that you got to do the work.
Right.
There's a difference between doing the work in the research and understanding the company and just picking stocks because I guess the best word would be you're speculating, right?
Right. Well, you can get lucky.
Yeah. Well, sometimes better be lucky than good, but still.
And there was a manager, Peter Lynch, who did the Fidelity Magellan Fund, and he was an all-star back in, I guess it was the 70s. And, he wrote a book and basically said, take a look at the things around you. And if there's things that you really like, the chances are a lot of other people do. And that's a place to start. But what he doesn't really say, though, is all the research that he does, that he did and all the other managers do who look at stocks. So, yeah, I mean, you could say, hey, here's a company I think should do well. And if it does, great. But, I think you need to do more than that. You really do need to do homework. You need to know, how much debt does a company have? What is their market share? Who are their competitors? Where are they? There's just a lot that goes into it. So you can try it yourself, and certainly a lot of people can do it and make some money. But I guess that's why we're in business, because that's what we do professionally.
I know that makes a lot of sense.
Yeah. So again, go back to this again. You don't need a ton of stocks. Lou did a great job. Anybody can do this. We'd love to help you. Be more than happy. I've said this before in other podcasts. Be more than happy to talk to you. You can give me a holler. We can do a Zoom video conference. There's a good example of a stock that has Zoomed. Why? Because we're doing it. Amazon, another company I've talked about before. Apple. All these companies. They are the ones that people are looking at and saying, "Hey, I have, in the past, people have made a lot of money with." Now, who are the new ones today? Well, that's what we try to find out. That's what we try to do. I've got a bunch of those in my caveman portfolio that this year have done very well. Love to talk to you about those. So again, before you go out and buy anything, do your homework. If you've got, and we don't know your situation, so don't take it just from me. If you've got an advisor, make sure you talk to that advisor and let them know what you're thinking and collaborate. That's a good way of doing it. So to all of you out there, you can all become rich doing stocks, with buying stocks. It helps if you're younger. When you're 80 years old, it's tough because you don't have enough time to do that. But if you're a younger person, especially, I told my own kids, if I were your age and they're now 40, and I told this 10 years ago, I would just buy stocks. I wouldn't have bonds. I wouldn't have anything else. I'd buy some really good companies, that you think that over the next 10, 20 years are going to do great. Put your money in there and watch them grow.
It's funny you say that. So my kids are 11 now, and I think when they were about 4 or 5, I started explaining this in the best terms that I understood to my kids, because I really wanted to. This business has been, I've been on this ride for 20 years in being married to this business, so to speak. If a lot of you don't know, my wife is a partner here at the company, and so I'm on the marketing side, and I've watched this business and this industry, and really to see what's possible. I really wanted my kids to understand this. So when they were about 5, and I know, Steve, you'd explained to me what dividend stocks were, and I thought those were fascinating because they just spit out a dividend, which is income, and I thought that was one of the best things in the world, especially for my kids to understand. So I know when my daughter asked, she started asking what her mom does, and I explained to her. I said, well, there's these things called stocks, and you can learn how to make these stocks spit out money for you. They just make more money. They're like little money soldiers, and so whenever she gets money, she buys stocks. Not all of it,
right?
But I wanted her to learn individual stocks, because I think that's where you experience the. Now she goes to McDonald's and she goes, hey, I own part of this. She goes to Starbucks and she picks them. She's more of a speculator right now. She can't do financial statements at 11 years old.
Right. But I'm sure that Catherine Magana, who is my partner, and you have a lot to say about what she's buying.
Catherine more so, and we also wanted them to get binged up a little bit. We wanted them to experience the wins and the losses, to the reality of what this is. But when it came to, hey, should we put them in mutual funds or ETFs or stocks? I said, look, they're not going to understand this and how powerful this is unless they pick stocks, because then they'll get the concept and then everything else will follow. That was just my view. But I find this a very amazing business, and the stocks themselves are very exciting.
It's funny that you did that, because with my kids, we talked about what companies or what places do they go. And we talked about a lot of different places, and they absolutely love Popeyes chicken, which I do too, by the way. It's one of my favorite chicken places. At any rate, not the healthiest in the world, but it's sure good. At any rate, we decided after doing some homework and doing the research that we were going to buy Popeyes. And about a year later, it got bought out. So they made some money, and they felt pretty good about that. So yeah, it's a learning experience. You need to lose sometimes. You have to realize that you're going to lose. No matter what anybody tells you, if somebody comes along and says, I never lose any money, run the other way.
Yeah, I think that's probably the biggest thing that I got from. I always have these knee-jerk reactions when Steve tells me things because he sees things from such a different perspective, and I just get kind of the glossed over version, the safe versions, right? And I go back and I start mulling it over, and I guess the first thing I thought is, to some degree, if it's too good to be true, it probably is. If there's a reason if you're getting crazy returns over time, it's possible to end up like the doorman, right? You can everybody hits black once in a while,
right?
But as those returns get higher, there's a risk associated with that, and even with is it Lou? Was it the
Lou?
Even with Lou, I thought about it. I go, well, that was great, and he won big, but he also took big risk. The big risk was, as you said, he put it all in one,
right?
And he won.
Right.
But there is, and I think that's kind of what we're talking about here. And you mentioned it's not the way to do it. There's risk involved. But you know what? A doorman made $3 million and he's retired for life.
Well, I don't know if it was 3 million, but it was in the millions.
Yeah, millions. Whatever it was.
Yeah.
I don't know why that number stuck in my head.
Yeah. Well, I guess the point is that you can beat the market. It goes back to the whole reason for talking about stocks is that you don't have to settle necessarily for a stock market return. Now, there's nothing wrong with that. I mean, stock markets have done well over the course of time, and if you have time, it's a good thing. But you can do better. You don't need a ton. You just need 5, 6, 7, 10 stocks that you really have done your homework, you think are great. And when it goes the other way, by the way, when it starts going the other way, you've got to reassess why you like the company, okay? And make sure that it's not going down just because the market's going down or some temporary thing. That's where the real brains of this comes in, if you will. The real intelligence and the art, I suppose, too, of buying and selling stocks. To know the difference between when structurally something's wrong with the company and whether this is really an opportunity to buy. But at any rate, Lou is good. Congratulations to him. I think anybody out there can do that. Love to talk to you. See us at wwmfinancial.com. And I guess we'll see you next time on Steve's Stock Stories. Thanks a lot.
Looking forward to it.